Hey YouTube, hi friends, welcome back to the channel. Friends, in today's video I will discuss about a very simple investing framework which I use in my investing. This by no means is an investment advice, but you can use this to make investing decisions and to park your money or take positions in the stock market. Well, this is a very safe investment approach because here you're investing in the index, but you're timing the index when it is expensive and when it is not expensive. And if you do this approach, you can make a big alpha over the mutual funds, because here you're basically evaluating when the market is expensive, buying bulk positions, taking bulk positions over there, and when the market is inexpensive, you're staying out of the market, or not investing majority of your capital. So we will be using to assess whether the market is expensive or inexpensive. We will be ideally we use three approaches, which is price to earnings ratio of Nifty 50, and we are only talking about Nifty 50 index over here in India. So price to earnings ratio. Second is earnings analysis, and I'll make you understand this in a very simple way, right? And third is the Dow theory. Well, Dow theory I'll cover in a separate video, but even if you understand these first two things, you will be very good. And after this video and with the use of AI, how I do it, you can do this very easily. Okay, so price to earnings ratio is basically an assessment of what is the sentiment in the market, which is basically how much people are willing to pay expensively for the same index, right? So price to earnings ratio tells you that. Now, to simplify things, I have divided Nifty P by V in three levels based on historical levels and some research which I have done. And if the Nifty 50 crosses that level, the P by E, we basically can assume that it is expensive or inexpensive, and we can take positions, right? So the levels which I have decided is between 17 and 19, 19 and 21, 21 and 25, right? So above 25 it is very expensive. Between 21 and 25 it is moderately expensive. Between 19 and 21 it is inexpensive. Between 17 and 19 it is cheap. So our best situation from solely by P by V perspective is to buy bulk of our positions when it is cheap, between 17 and 19, right? And if it happens, very good. If it does not happen, then majority of accumulation what we should do is below 21 level, 21 P by E level. And by the way guys, I've covered in a previous video how to find this P by E levels. You can use the websites like Trendline, and there are 2-3 other options. Just do a Google search and you'll find out, or do a Perplexity search if you can use AI. Perplexity is a very good AI for this. So what you have to keep in mind is majority of your bulk you have to buy within 21 P by E, right? Next is your earnings analysis. So what is in your favor if both P by E as well as the earnings are low? If both are low, then you are in a really good situation, right? Because you're buying index at cheap earnings and cheap P by E. So if you just wait for 4-5 years, the company's earnings will catch up at 15 to 16%, which is the GDP growth rate of India, right? So after 5 to 6 years, you'll get this GDP growth rate. And if you bought Nifty P by at P by E low levels, then P by V growth also you'll get after 5 to 6 years. If you sell it 25, 26, so you'll get a very good overall growth rate, right? So you basically use ChatGPT, right? And similarly, I have done over here. So you go to ChatGPT and you basically ask us to give you this table, which is for the last 10 years, give you the closing level of Nifty, the P by E ratio of that level, the earnings of that year, which is right, and the year-on-year earnings growth, right? So earnings in very simply is nothing. So if you have P by E, it is price So price is equals to earnings into P by E. So if you just look over here in this formula in P by E, the denominator is earnings, so this earnings and earnings cancel out, so you get the price. So to calculate the earnings, you have to divide price by P by E ratio. Price by P by E, you just take this thing here in the denominator. So price by P by E will give you the earnings. So in this table, if you get the P by E ratio of the year and the Nifty levels, which is the price, and if you divide this price by the P by E ratio, you'll get the earning for that year, right? Now what we're interested is in the earnings growth. So this is just a number, this is just a representative number, it's not the actual earnings of the economy, right? This is a representative number which gives you an idea, and based on this you can draw an estimate. So that is the beauty of this, right? So year on year earning, if you're getting according to the GDP growth rate, it should grow, our economy should grow at close to 13-14%. So that is the earning. If it is lower than this level, like if you can see in this table, I've already drawn a table over here. Where is my table? Here is my table. Let me open up my table. Yeah, here is my table. So if I have already drawn the table, you can see that the earnings for the last from 2015 to 2018 were low. So that basically says that in the years to come the earnings will catch up. So one year you'll get 30%, then 12%, so average will be 14 to 15, right? It will catch up to that average. So if you're in this range, then the earnings are low, and if you also find a situation over here where the price to earnings ratio is low, P by E is low, then that's a golden opportunity, right? So it came into COVID time over here. If you can see the earnings of -13 and the P by E, this is for the close of the year, but if you just look at the middle of the year, which is May or June, it was very low. So that was a good opportunity. Likewise, there are times when it touches 28 and 37. This is again the COVID year, but above 22 it is expensive. So what you have to do is accumulate most of the index at P by E of less than 21, and then sell it again after 5-6 years at 21, above 21 if possible, right? Preferable. Just wait for the time when it crosses 23, 24 and just sell it after 5-6 years. So what will happen, you'll get the earnings growth in that time, which is 14 to 15%, and you will get the P by E growth also if you sell at 25, 26. So you can take you can basically consider this very simple approach to make a position in the markets. Now what happens if you have a lump sum sitting outside? So let's say if you have 10 lakh rupees and now you want to take a position in the market, or let's say you have bigger amount also, does not matter, but I'll just give you an idea. So 2% of this 10 lakhs, which is around 20,000 rupees, you just keep investing in the markets every month, right? So when the Nifty P by V is less than less at around 21, close to that level, right? It's not crossed 22. You keep investing this 20,000 in the market, and whenever Nifty P by V goes below 19, just you double this amount, to 40,000. So by doing this systematic transfer plan, what you're ensuring that you're making a bulk position in the market at lower P by E levels, and then you just sit on it for 5 to 7 years or even more than that time, right? And you'll get the earnings growth of Nifty P by V. Just by using this simple approach, you'll ensure that you're not making the mistake of buying the market at a higher level, right? With this very simple approach. Now in the next video, guys, I'll cover I'll add one more element into this, which is the Dow theory, which is just by which basically tells us from the chart how can we include one more parameter to confirm whether the markets are going to blow up or they have strong chances of crashing. Again, this video is not an investment advice at all. This is for my compounding machine community. This channel is very old. I want to thank all of you guys to stay with me, and this I've been pretty lazy in making videos from quite some time, but as and when I have an update in my investing and I'm making some good positions, I make a video for all of you guys. Thanks again for watching the video, guys, and I'll see you again in the next one. Till then, take care, bye bye, and I will see you soon. Thanks for watching. Bye bye.